Welcome to the Deep Dive, where we unpack the latest research and calls. Today, it's Worthington Steel, ticker WS, and their Q2 fiscal 26 earnings.
And this one was fascinating. It's this perfect duality. You have a massive revenue beat on one hand.
And an earnings per share miss on the other. It created some serious whiplash in the market.
Total whiplash. You saw that immediate gut reaction to the EPS miss. But the real story, and what we're going to break down, is how quickly investors reevaluated the quality of that revenue.
Right, because they're trying to do something fundamental here. They're trying to reshape the entire business.
Exactly, moving away from that commodity cycle. And that's why the smart money, ultimately just shrugged off the short-term noise.
Okay, let's frame the numbers because the contrast is pretty stark. Net sales came in at $871.9 million.
I mean, that's an 18% jump year over year. It just blew past what analysts were expecting. Their commercial engine is absolutely firing.
It really is. But then you get to the bottom line, adjusted EPS, 38 cents a share.
Right. And look, that's double what it was last year, which was 19 cents. That's good.
But the forecast was 48 cents.
And that 10-cent miss, that's almost 21% below the estimate. That's the number that hit the wires and, caused the initial panic.
And we really saw it. The stock gapped down 4.4% right at the open, just a classic knee-jerk reaction.
But here's the interesting part for you if you're following this. It didn't stay down.
Not at all. It rebounded through the day, closed almost flat, and even hit a high of $38.59.
Which tells us that in, 5 hours? The market figured out the noise was temporary and the signal was strategic. The focus shifted to the quality of the business.
And to the margins. Adjusted EBITDA hit $48.3 million. That's a 5.5% margin.
And this is the key number. That's an expansion of 140 basis points year over year.
Let's quickly define that. A basis point is 0.01%.
So 140 basis points means they boosted their profit margin by 1.4 percentage points. That is a massive lift, especially when they're saying some of their markets are, quote, soft and competitive.
That margin expansion is the proof of the strategy, isn't it?
It's the direct validation.
So let's get into that strategy. The core of it is moving away from low-value services, specifically something called toll processing.
Yeah, think of it like this. Toll processing is like being a hired mechanic. A customer brings you their steel, you work on it, and you get paid a small service fee. It's low margin.
You don't own the car, you just fix it.
Exactly. With direct sales, they're buying the raw steel, transforming it, and then selling the finished high-value product. They own the whole process and capture the full margin.
So they're taking on more risk, owning the inventory, but for a much bigger reward. Is there a metric that shows this is actually happening?
The mix shift. It's a crucial metric.
Yeah.
Direct sales made up 65% of the tons they shipped this quarter.
65%. And what was it a year ago?
It was 55%. So that's a 10-point jump in 1 year. Direct volumes themselves are up 13%. This is a fundamental change to their business.
Okay, so that explains the better operating performance, but we still have that EPS miss. EBIT, earnings before interest and taxes, was up $12.3 million. Where did that come from?
Well, the biggest driver was those improved direct spreads. They were just getting better prices for their products.
And there was another tailwind, something about inventory.
Yeah, a favorable $6.2 million swing in pre-tax inventory holding losses. Wait, hold on a second. A $6.2 million inventory swing sounds a little like they just got lucky with timing, right?
Yeah.
Not pure operational genius.
That's a fair point. And management would say inventory swings are part of the game. But what it really means is they weren't caught buying steel high and selling it low, which has absolutely crushed some of their competitors recently.
Okay, so it shows good management, if not a repeatable game.
Right. And the other piece was higher earnings from their joint venture in Mexico, Serviacero. That is sustainable. So it's a mix.
But those gains still weren't enough. Which brings us to the headwinds, specifically the SG&A costs, selling, general, and admin expenses. Correct. SG&A was up $9.8 million. This is the smoking gun for the EPS miss.
And management broke it down for us.
They did. About $5.9 million of it was higher compensation and benefits. But the really telling part...
True professional fees.
Exactly. Another $2.3 million in higher professional fees. And they were explicit. These fees were for evaluating strategic projects.
Which, given what we know, means M&A due diligence.
It's M&A. So the earnings miss wasn't a cost problem. It was a deliberate investment in future growth.
That completely reframes the narrative for you as a listener. Okay, let's see where that investment is paying off. End market performance. Where did all this direct sales growth go?
Automotive was the absolute star. Direct shipments to auto customers surged 26% year over year.
26%, that's huge.
It's massive. And it's coming from two places. First, market share gains from new programs finally hitting full speed.
And the second one is, I think, even more important for the long-term thesis.
Supplier onshoring. They called it out specifically, said a significant amount of recent gains came from automakers wanting to secure their supply chains here in North America. That's a tailwind that could last for years.
A huge macro shift that they're benefiting from. What about outside of auto?
The energy segment was also really strong. Shipments were up 50%.
50? Wow.
Yeah, 50. Mostly linked to solar projects. So it shows they're getting diversified strength, which is key.
But it wasn't all good news. Some markets were genuinely soft.
Yeah, construction was a weak spot, down 9%. And the heavy truck and trailer market was down 6%. They said both are soft, competitive, and feeling the heat from interest rates.
Okay, so that brings us to the long cycle growth story. This is the thing that justifies all that spending. Electrical steel.
This is the core of their transition. They're spending about $110 million in capex this fiscal year, and it's pretty much all going towards specialized electrical steel capacity.
And they gave us clear timelines, which the market loves to see.
They did. The Mexico facility, which is for traction motors in EVs, should start initial production in the first quarter of calendar 2026.
And the Canada facility.
That one is for transformer cores, the electrical grid. It's also transitioning to a new facility in Q1 of 26. And here's the kicker. They've already secured business to fill over 60% of that new capacity.
So it's not a build it and they will come situation. They've already got the customers lined up.
Precisely. It's a build with line of sight revenue.
And it's not just about building factories. They also talked about innovation, right? Differentiating their actual product.
That's the secret sauce. They announced a new patent-pending lamination technique called full surface bonding.
Sounds technical. What does it do?
In simple terms, it makes electric motor cores more efficient, more durable, and cheaper to produce. It's a high-tech solution that automakers can't just get from anyone. It turns their steel into a premium product.
Okay, let's pivot from the physical assets to the internal ones, their back office transformation, and AI.
This was a unique part of the call. Most steel companies talk about improving the factory floor. Worthington is taking that same playbook and applying it to their administrative processes.
Industrializing their white-collar work.
That's a great way to put it. And they gave some small but concrete examples.
Right, the 2 AI agents in the credit department.
Yeah, they expect that to eliminate over 350 hours of manual work a year. That's not a huge number, but it's tangible. It's real.
They also mentioned automating shipping notices, which sounds boring, but actually helps them get paid faster.
It's vital for cash flow. The message here is that the high SG&A isn't just bloat. It's being spent on strategic things like this, designed to drive long-term efficiency.
But the market needs proof, right? They can't just take management's word for it.
And that's why they made a really important promise on the call.
The transformation scorecard.
Exactly. They committed to publishing a quantified transformation scorecard on the very next earnings call. It's going to have hard metrics on savings and hours redeployed. That scorecard is the accountability mechanism.
Okay, moving to guidance and the macro outlook. Let's touch on M&A. Any updates on the rumored talks with Klockner & Co.?
They maintained total strategic silence. Just pointed back to their December 6th statement and said they wouldn't be taking any questions on it.
Which is frustrating, but standard procedure.
Standard procedure. It keeps that M&A option value firmly in play for investors.
Now let's talk steel prices. The volatility in hot roll coil, or HRC, is always a challenge.
A huge headache. HRC went from about $800 a ton to $900 recently. And because of how their contracts work, a sharp move like that can really hurt their inventory value.
So that explains their cautious guidance.
Precisely. For Q3, they guided to a range for inventory holding impact of anywhere between a $3 million gain to a $3 million loss. That's a wide range.
And what about the galvanized spreads that were weak because of construction? When do they see that getting better?
They're pointing to the second quarter of calendar year 2026. They're hoping for lower interest rates to restart demand and for tariffs to keep imported competition at bay.
So zooming out, what's the overall outlook?
They're calling it cautiously optimistic for the first half of 2026. They believe things are setting up for improvement in the back half of the year. It's a balanced tone.
Which brings us back to why the stock bounced. The market basically decided the EPS miss was a temporary funded cost, and the revenue beat was high-quality execution.
That's the whole narrative shift in a nutshell. Investors saw the 65% direct sales mix, the auto growth, the electrical steel investment, and decided that outweighed the short-term noise.
So what are the key catalysts we should be watching for?
Three big ones. First, seeing actual revenue from those new electrical steel plants in the first half of 26. Second, some kind of resolution or clarity on the M&A front.
And third, that scorecard.
And third, that quantified transformation scorecard. That's the piece that validates the high SG&A spend as a real investment.
It's a classic transition story. They're spending now to pivot to more specialized, defensible products.
It's a bold gamble, but the early numbers suggest it's working.
Okay, that brings us to our final segment, where we find the outrageous but plausible trade idea. Hashtag, this is not financial advice. All right, for our trade idea this time, we're focused squarely on that transformation. Worthington is moving from being a commodity processor to a specialized solution provider. We think that shift is undervalued.
And that intraday high of $38.59 suggests the market agrees, or at least sees that potential. It's a viable target.
The challenge, though, is you still have to deal with all that commodity volatility they flagged, the HRC price swings.
So you want to isolate the bet on their execution from the general market noise.
So the pitch is this: a leveraged directional bet. You go long on Worthington Steel equity, betting on their operational results and that M&A option.
To hedge out the commodity risk you don't want, you simultaneously take a short position in a pure-play commodity steel processor.
A competitor who is not making this specialization shift.
It's a classic pair trade.
Exactly. You're betting on Worthington's strategy divergence. The idea is that the M&A happens, or that Q3 transformation scorecard is so convincing that it justifies a major re-rating, pushing WS well past that $38.59 ceiling.
While the company you're shorting just sort of treads water with the rest of the commodity market.
It's a very targeted bet on strategic execution. If that catalyst cluster hits in the next 6 months, it could pay off big. But as always, this is just an idea. Definitely not financial advice.
Absolutely not.
To wrap up, the key takeaway is that Worthington is executing a planned transformation. You can see it in the 65% direct sales mix and the strong auto and energy gains. They're paying the price now to get the benefit later.
Which brings us to our final provocative thought for you. Management has committed to holding operating expenses flat, even as they grow, because of this AI and back office transformation. That scorecard next quarter is the moment of truth.
The big question.
Will those efficiency gains be big enough to prove that the SG&A bump was a successful investment, allowing them to finally turn this revenue beat into a sustained EPS beat? That scorecard holds the key.
Thanks for joining us for this deep dive into Worthington Steel. We'll be back soon with more analysis.